Hello everybody. Okay. Hopefully this is working. I had some difficulty getting the audio to work. I just got a new microphone. It's this one from GameStop. It was the deal of the day a couple days ago, and GameStop got it delivered to me in a day. That was pretty impressive. I think I paid $49.99. So I have a Blue Yeti, one of these guys, silver one. But for whatever reason, it just sounds really terrible. It might be because of the room that I'm recording in. I don't know. I'll figure it out. Anyway, what the heck happened today? Because GameStop took a huge dive. 13%, down 13% on the daily. We're up 2% in the after hours, but you know, what the heck happened? Let's try to figure it out. Okay, so today was the FOMC minutes, and they announced a bunch of things. They announced that they were going to hike rates, and it caught a lot of people by surprise. It didn't catch, you know, me and a lot of the macro people on Twitter by surprise. We expected this, but some people are permanently bullish, and they didn't think that the Fed would actually follow through with the taper, the double taper, the rate hikes. They didn't think that that would happen, and they did. The minutes were super hawkish, super bearish for the stock market, and everything fell today. Crypto fell, stocks fell, meme stocks fell. Very few things actually went up, and we're going to take a little bit of a look at that today. So what does that actually mean? If they're going to hike rates, it basically makes debt more expensive because your interest rate rises. You have to pay back more money on that debt, and that's typically really bad for tech stocks or anybody that's heavily in debt. Okay, because typically tech stocks in particular are heavily indebted, and they need to make those payments back. So at that point, it's going to depend on how you cash flow. If you have a lot of cash flow, then you can service those debts. If you don't cash flow, you're not going to be able to service those debts. If that goes on for too long, you're insolvent. You go out of business because you are defaulting on your debt. You go bankrupt. So it really depends on the company. If you don't have debt, then this should be neutral. It might even be good if you can cash flow and have no debt, because then it makes your company more attractive to investors, right? But these markets are a bit irrational, to say the least, and people aren't really thinking that way necessarily. Not everybody, anyway. So yeah, today's Fed FOMC minutes were very hawkish, took some people by surprise. And so, man, okay, a lot of people complain about the inflation that we're getting, and I, you know, debate them on this because I keep saying that it's not monetary inflation. I'm not the best person to talk to about this. You know, I constantly reference Stephen Van Meter, Colorado Travis. This guy Macro Alf is also really a great person to follow on Twitter. And it basically boils down to an argument between whether the Fed prints money or not. So the macro view is that the Fed does not print money because there's no mechanism by which the Fed prints money. The way that I understand it is that hedge funds take quantitative easing as an excuse to short the crap out of the bond market, and that's where the money's coming from. But that's debt. That's another form of leverage. It's another form of margin, because it's money that you borrowed by rehypothecating treasuries that you sold into the market. Those theoretically need to be bought back. It's borrowed money. It's not money printing necessarily, right? Maybe we are arguing about semantics. You know, it gets a little hairy. But anyway, the idea here is that the economic conditions are not good, right? Despite what the JOLTS job survey numbers say and the unemployment and all that says, you know, you just take a look around you and you realize that the economy is not very healthy. So when a lot of traders are saying that, you know, rate hikes need to come, the point is that the macro view is that we can't afford to raise rates. You know, when you raise rates and debt becomes more expensive because you have to pay back more money. You can't afford it because economic conditions aren't good enough. You know, you can look at money velocity, money's just not going around. All these reasons that we won't get into because I'm trying to make this a quick video. So we may be seeing a situation where the Fed tapers quantitative easing, but they don't raise rates. Now they've threatened to, or I don't know, the Fed has said that they're going to raise rates 3 times this year, 2022, maybe 4 times. Stephen Van Meter says probably only once or twice. Me, I don't know. I'm not experienced enough to be able to tell one way or another, so I default to people smarter than me. Regardless, though, because there's not more money from shorting or wherever being pushed into the market, it cannot sustain these high valuations, and so that's why we're seeing a pullback. We can see this in the loans and lease data as well. A lot of people like to fight over this too. The reality is that we live in a Keynesian debt-based economy. That's the reality. I don't think that's a great system. If you're a fan of Austrian economics, I agree with you. If you want to talk about crypto and how crypto can fix these things, I think it's a great idea. I just don't see people adopting it right now, so we got to stick to reality. So what does reality tell us? It tells us that loans and leases haven't been growing. Now it's spiked up here and it looks like it's recovering, but if you drew like a straight line here, we're still technically under. Let's change this to change from a year ago, and we can see right here we're still underneath where we were pre-pandemic, which suggests that loans and lease growth is not growing fast enough to support current levels of inflation, asset price inflation, whatever you want to talk about or complain about. We can look at commercial loans and leases as well. Commercial and industrial loans. We'll zoom into current time period and change this to year over year. And same thing here. We're actually negative, right? We're actually negative from where we were pre-pandemic. And actually, pre-pandemic, we were slowing down, headed in the wrong direction. So none of this is a good sign for the economy. Even without the pandemic here, we were not headed in the right direction. Okay. So again, the Fed hiking rates is bad if you're heavily indebted. The only exception is, well, 2 exceptions is if you're not indebted, if you don't have a lot of debt, or if you cash flow enough to be able to service that debt, meaning that your company makes enough money to be able to pay back what you owe plus interest. And so there aren't that many companies like that right now. Tech in particular is notorious for not making any profits and just kind of coasting by, the idea is that they will scale and eventually make money at some point in the future. And that's looking like it's not going to fly if the Fed hikes rates. We can think of some other companies. So I'm not trying to talk trash. AMC. AMC has a lot of debt, and their cash flow currently is still not recovered from pre-pandemic levels. And so on paper, the reality is that AMC can never make back enough money to pay back their debts plus their interest payments. And Adam Aron recently tweeted that he was going to try to restructure some of that debt. We'll see where that goes. GameStop has no debt except for this, the $500 million ABL facility. It's a line of credit. We don't know too much more about this, or at least I don't, so I can't really comment. But with $1.4 something billion cash on hand, they can easily cover this without a problem if they need to. So I'm not worried about GameStop as far as debt goes. Okay, speaking of debt, we also have to look overseas. There's a lot of attention paid to Evergrande, but actually Small is probably worse because, long story short, they're supposed to be a more trustworthy company, less indebted, fewer obligations. But as we can see from this chart here, because of contagion, people aren't really trusting it either. And this is the daily chart, and this orange line, this orange horizontal line that you can see going across to a bunch of different volumes and profile, that's the point of control, meaning that is the point where the most number of shares have been trading. And right now what you see for Small is that it is trading sideways on that line, meaning that it's killing time, it's indecisive, it doesn't know what it wants to do. If it breaks below this orange line convincingly, that's not good for Small. But more importantly, that's not good for Chinese real estate developers in general, because if even a more trusted company cannot convince investors to stay invested, then we'll know that the contagion is real, and people in general, all over, are desperately trying to get out. They don't want to hold these bags. And that's bad. A lot of these developer companies right now, they're like one step above full default status. They call it restricted default. And if they go into full default, that's it, game over, right? We've talked on this channel about how money gets created and destroyed. A default destroys money. And considering that Chinese paper, it backs a lot of things, right? It backs Tether, and therefore it backs Bitcoin, and therefore it backs a lot of cryptocurrency, and it probably backs a bunch of other stablecoins, which are used to trade other altcoins, and including Bitcoin. Banks have it; they use it as collateral. Very quickly, we can see, that if this goes into full default, Small or Evergrande or Kaisa or any other Chinese developer, if they go into full default, that can be really bad for the global banking system, because money's being destroyed, that collateral is worthless, and it can lead to a cascading or domino effect of defaults and bankruptcies. Okay, so this one is China Evergrande. As we can see, the biggest POC, or position of control, point of control, is above where the price is now, meaning that people are more bearish on Evergrande than Small. Okay, all right. Right. What did I? Okay, so right. Okay. For people who trade with Fidelity, I'm not sure about other platforms, but for Fidelity, where did I put it? If you are a Fidelity user and you have Active Trader Pro, which apparently doesn't work on iOS, it only works for PC, Windows. If you go into the News and Research tab, you'll be able to access Bloomberg TV for free. And at the bottom, you'll also see the economic calendar. So you'll be able to see all the events coming up. This is usually, much better than the calendar I sometimes post on Twitter. But I was watching Bloomberg TV today during the minutes, and I found it pretty funny because the anchor on Bloomberg TV first said that they were surprised by how hawkish the Fed was being, and then minutes later they said that they knew that the Fed would be hawkish. So, I don't know. It's comedic to me. All right. They also said, the FOMC meeting minutes said a number of Fed members believe that a significant increase in labor force participation would take longer than originally anticipated. And, this is, our labor force participation rate hasn't been the same since the year 2000. And there's a lot of reasons for this. Baby boomers is one of them. We had a lot of baby boomers still in the labor force back in 2000. They're mostly retired now. But look at this over here in 2020. I mean, COVID just kind of cut whatever labor force participation rate was left in half, and that's not good. That is not how we get a healthy economy kick-started again. And whatever the Fed tries to do, it doesn't seem like people are willing to go back to work. There's lots of reasons for it, quite frankly. It's out of the scope of this conversation. We will talk about it some other time, maybe. They also said that the Treasury market was vulnerable, and their concern was that the vulnerabilities would slow the rate of balance sheet normalization. And what that means is that the Fed's been doing quantitative easing. They've been buying back a ton of U.S. Treasuries, but also mortgage-backed securities, a little bit of corporate bonds at the very start of quantitative easing, but barely any, virtually none. So really, it's going to be the mortgage-backed securities and the Treasuries. I interpret this because, as they know about the short selling in the Treasury market, particularly right now, the 10-year. If you go to Hedgeopia, let's go to Hedgeopia. Where is Hedgeopia? We can see the positioning here. So the green histogram in the background, ignore the red line. That is the 10-year note futures, and this article was written yesterday. So it looks like they were very short, and they covered some, but they're still short. Let's look at the 30-year. It looks like, yeah, they're slowly starting to cover the 30-year. But the point is that there's all this money being saved up in the banking system that you can see in the overnight reverse repo. And that needs collateral in the overnight reverse repo market, and that's bonds. We are currently, according to Stephen Van Meter, I forget his source, lowest allocation to bonds in history, and that's very risky behavior by banks and fund managers. So his thesis is that TLT is inevitable. That being said, that took a hit lately as well. Yeah, crypto dropped even more than stocks did today. So yeah, it's a bit of a confusing day because everything fell. We're going to look at the charts in a second. I'll show you. But this is what I was saying about GameStop. GameStop got knocked down 13% on news of the Fed rate hike. And rate hikes are bad for companies that have a lot of debt. And GameStop is not that heavily indebted. They just have the, $500 million line of credit, the ABL facility. So, yeah, unless there's something I'm missing, I don't see why a Fed rate hike would affect GameStop that much. So, make of that what you will. The other thing that I noticed was that, yes, it did drop, but look at the slope here, especially towards the end of the day, right? Not the last, 3 candles, because that's like 9 minutes, but like in general, look at the slope. It's like 45 degrees down-ish. But look at Tesla and look at Apple after the Fed minutes were announced. I mean, they just straight up dropped at like, I don't know, what is that? Like a 60-degree angle down. I mean, that is pretty sharp. Now, percentage-wise, they didn't drop as much. But GameStop had been dropping all day. Tesla was kind of trading sideways a little bit. Apple was gently going down. I guess Tesla too. So, it's weird. I don't know. I don't know what to make of it. Mac 10, Suburban Drone, is another person that's really good to follow on Twitter. The point of this is that the Michigan Consumer Sentiment Survey is a very well-respected survey that comes out regularly. You can check it out on investing.com, the economic calendar. But consumer sentiment is low. It's very low. It's almost as low as, well, it's headed in that direction of the 2008 Great Financial Crisis, right? We're about the same here. Remember, the 2008 Great Financial Crisis, it kind of kicked off in 2007. It blew apart in 2008, but the market didn't crash until 2009. So the sentiment is very low all around here. We're around those levels again, but airline stocks are still pretty high, and currently they're trending higher. And oil stocks are mooning right now. They're going really high. And the thing to know about oil stocks in general is that oil always peaks before a market crash. Or almost always, but it's a pretty reliable indicator that oil peaks before a market crash. And it kind of makes sense because a lot of it has to do with consumer sentiment and spending behaviors, right? Consumers make up 70% of the economy, and if oil and energy is too expensive and food is getting expensive, and these are all things that are happening right now, consumers are getting squeezed at the margins just to live and to carry on with their daily lives. And so that leaves very little money for anything else. And you can check the Fed charts as well for consumer discretionary income, disposable income, and even the savings rate, and they're low, which means that people have no money to spend on anything else in the economy. So the fact that the market is this high kind of makes no sense from a macro standpoint. Now, of course, you'll see permabulls on Twitter talking a lot of trash because it's hard to kill a bull and it's bullish until it's not. So, yeah. Same thing here, right? A lot of bulls are incredulous that the Fed would be taking these actions because they think that the Fed will never let the market crash, and that they'll always backstop the market, and that doesn't appear to be true this time. The important thing to note here is that tech is bidless, is what Suburban Drone is saying. And when something is bidless, you have to keep lowering if you're trying to sell, you have to keep lowering your price until you find somebody willing to bid for your shares. And that can lead to a liquidity crisis, similar to what we saw in March 2020, similar to what we saw in much of September of this year, or of last year, and similar to what we saw today, is that, when things crash, it's because no one wants to buy. But people want to sell, they want to get out, but there's nobody to buy. So that can happen. It's possible. TLT, a lot of the macro guys are long on TLT. They're bullish on TLT, and they like long duration US Treasuries, and they like it for the longer term, meaning, more than a few months, year, 2 years, couple years, whatever. And I found this today that was pretty interesting, and this makes sense. This chart makes a lot of sense. At the beginning of a month, hedge funds and short sellers, they like shorting the crap out of bonds because they get money up front, and then they slowly cover their position as the month progresses, and by the end of the month, the price of TLT peaks. So this is a pattern that you can see. Now, I don't want to say you can rely on this, but this is an interesting pattern that is apparent, that emerges. All right, I got to wrap this up because I got to go soon. And what did we see this month? New year, new month, first of the month, or first trading day of the month. TLT got slammed. We'll go to the charts in a minute to see that. Crypto gas is really high as well. Make of that what you will. Here's another guy that's really worth following. Bellehos, Bellehos. TLT, he thinks TLT can go to 141. He's been right before. So will he be right again? I mean, we came pretty close today. I think we hit 142 today. And he thinks that this is going to be like some crazy 10x returns. I mean, he's probably talking about call options. Because TLT is not going to 10x per share, I don't think. A lot of guys think it'll go to 200. It's at 142 right now, 143 right now. So he's probably talking about call options. Again, this is not financial advice. This is not a recommendation to buy, sell, hold, whatever, anything. We're just talking here, okay? These are just things that I see that I'd like to share. Okay, EV over EBITDA. This is something that we've talked about before. This is something that Roaring Kitty, Keith Gill, and Michael Burry like to use as a screener to look for stocks. And if you don't have earnings because you've been reinvesting that money into fulfillment centers, hiring tons of people, whatever, then this will not show up. It'll be a null result. But a low score can mean that you may be undervalued. So if you're a value investor, this is a screener that you could run. And if you have a really high EV over EBITDA, you may be overvalued. So Tesla is at 143 at the time of this tweet. It's at like 180 now, I think. Actually, it might be lower now because of the crash this afternoon. Facebook is 16x. You can see this in TradingView, which I will show you real quick. All right. S&P's correlation to consumer sentiment is the lowest, meaning they're going in opposite directions. Consumer sentiment is really weak. Consumers don't want to spend money, but the S&P 500 keeps going to higher and higher highs. Last time we saw this low point was December of 2007, right before the Great Financial Crisis. Market top, beginning of the recession. Airlines, on the other hand, are 85% correlated to consumer sentiment. So when consumers aren't feeling that good, airlines suffer because there's no travel. And with, COVID, people aren't traveling as much either. So that all makes sense. That all checks out. All right, okay, yeah, Loopring, they're doing NFTs. You'll have to go to their Twitter page and click on the link to see how you can get one. If you have a Loopring wallet already, that's already improving your chances. The thing I like about this is that early adopters don't necessarily get special treatment in getting an NFT. It seems like, if I'm earlier than you, then we both have an equal chance of getting this NFT. So I think that's pretty fair. But I have to check. Don't take my word for this. I think whales still get a little bit of a better chance at getting this NFT. So we'll see. All right. So what did I want to show you here? Yeah. So everything got slammed today, which is weird, right? TLT got slammed. Look, it's red across the board pretty much. Pretty much all across the board. And yields went up. Yields going up. Again, the macro thesis is that yields can't, like, America can't afford for yields to go up. And that reminds me, if you're listening to this and you're an American, or if you're not, you have to think about things in terms of the US dollar and what the American government can or can't afford. Because the US dollar is the world reserve currency. So if you take it from that lens, then it makes a lot more sense. You may be seeing inflation in your local currency and in your local economy, local country, but if you go back to the dollar milkshake theory, Santiago fund, you'll understand that at the end of the day, the way the current economic system works, it is the US dollar. All right, real fast, because I really do have to go. This is the mostly Fangman, the blue chip companies, red across the board. That's pretty nuts for today. Metals and mining. News broke last night that Kazakhstan people were, I don't want to say rioting, but they were protesting, and apparently the government resigned or something. And there's talk about Russia taking over the Kazakhstani government. I don't really know all the details. They cut off the internet there, so we aren't even able to get like reliable updates or anything like that. But the important thing to note is that Kazakhstan, besides producing a bunch of metals, both common metals and industrial metals, they also produce 42 or 43% of the entire world's uranium supply, and that is useful for nuclear power plants and potentially weapons. Kazatomprom, because of the situation, fell pretty heavily today, but as a result, other uranium companies saw a morning pop. I think Denison was up 10, 11, 12% maybe in the morning. Cameco, same thing. And then as the Fed minutes was winding, was drawing near, everything fell. Freaking everything fell. Something I like to look at from time to time is all the different sectors in the stock market. If you're not familiar with this, look up stock sectors on Google, and you will get an explanation of that. But here's another interesting thing, right? The market fell a lot today. There was a lot of selling, and everything was red across the board. So where did that money go? Where did all that money go? It doesn't seem like it went anywhere at first glance. Real estate was down. The technology sector was down. Consumer discretionary was down. Like the financial sector was down. Normally, when you see yields rise, which we saw today because bonds fell, you would see financial sector responding to that, but I don't know. Everything was just falling today. Very, very interesting. Very weird. So, yeah, TLT. Let's see, 142. We'll call 143 right now. Is this the bottom? Maybe. Could it go lower? Yeah, of course it could go lower. I don't really know. We have to kind of zoom out and look at longer time frames. So, excuse all the crayons. I'm sorry. What is this price? 121? I doubt it. I really doubt it. So let's see where we are here. We're here right now. That's the 143s, and the next volume shelf here is in the 140s to 139s. Can it go this low? It could. I guess it could. But again, we saw money leaving stocks today in all sectors, really. It left crypto. It left, everything. And I'm personally confused why it didn't go into bonds, because bonds traditionally is the risk-off option. It's the flight to safety, the flight to quality, the flight to quality collateral. So I expect bonds to go up, but of course a lot of other people disagree very, very strongly with that. So we will see. What else? The dollar went down today too. DXY. Yeah, bit of a red day. Push back up at the end of the day. Futures market is starting to move. It's looking slightly green. We'll see where it ends up. What else do I want to see? Yeah, Bitcoin fell a lot. Holy crap, Bitcoin fell a lot. It's at 43.5. Wow. Ethereum, same thing. Loop Ring coin, same thing. Yeah, so I don't know. We're gonna have to see what happens. I personally bought the dip on GameStop today. What else? I had some other plays too that were profitable. I was bearish going into today anyway, so I was expecting this. But we'll have to wait and see. For me personally, again, this is not a recommendation to or solicitation to buy anything. I'm just saying the Fed rate hike and the sell-off in GameStop and a couple of other companies didn't really make sense to me, but man, we are in some wild markets, so be careful, everybody. Don't take care of yourselves. If you have to sell, need to sell, want to sell, that's your decision. If you want to buy, that's your decision. I'm an idiot. Don't listen to me for investment advice. I'm just talking here. So good luck, everybody. Yeah, good luck. Okay. We will talk next time.